everybody. Hope you guys are having a great day. We're going to talk today about something that I think is super important, something that's really big, that can impact your P&L more than you know, and it can have bigger impacts the longer that you stay in some of these positions. So today what we're going to talk about is the impact of commissions on your options trading. What does it mean, and how can I minimize it and control it so that I can reduce my exposure in a position without having fear of commission loss? If you're new to the channel, do me a favor, click the subscribe button, hit the notification bell so you get the alerts and the updates as they happen. But we're going to talk today about commissions and why they're so important. Now, before we even get started on this, the thing that we want to talk about is remembering the very simple concept. What's great about options is that you can make money whether they go up, down, or sideways. The stock doesn't have to move. And sometimes the best trades that we're going to look at are the ones that have the highest degree of probability, in that they can move all three directions. Now, they can't move an unlimited amount in all three directions, but we want trades that can move up a little bit and we're still going to make some money. They can move down as much as they want and they can go sideways and I still make money in a given period of time. The downside of that is that sometimes in order to get enough credit to make the trade worthwhile, you have to take a lot more exposure, and the exposure that you take can come back to bite you in the rear end. And so what we're going to look at today specifically is an option that expires in just a few days and how we could trade it with minimal exposure if we weren't so worried about commissions. Now, what are commissions? Commissions are the costs of making a trade, right? It's the cost that the broker-dealer puts upon individual investors and traders in order to make the transaction occur. Now, in most cases, stock commissions are mostly gone. Most brokers have decided we're not going to charge commissions on stocks because you've got to remember this. The way the broker makes their money is not only on the commissions that they charge, but also on bundling those orders and selling those orders to some sort of a clearing firm, right? Some sort of a firm is paying for those orders. Now, if you know that some firm is going to pay for your orders anyway, why would I want to pay commissions on top of that? Because most brokers are taking commissions and then they send that to a clearing firm that is then bundling those orders with others and sending it out to the exchange. And so if I know that my order is getting sold, why am I going to pay commissions on top of my order being sold? And so the stock brokers have basically said we're not going to charge commissions on stock anymore, which is why we've seen wider spreads in our positions. Well, the options traders are still paying commissions, and that may not be a thing that you have to do. And so I want to look at a trade that, with the impact of commissions, will greatly change what this trade is worth, what it costs you, and what it brings you. So let's go ahead and dive into it. So here we're taking a look at USO. Now, at the time of this, the USO is trading at $70.17 a share. And if we have a reasonable belief that USO is going to stay below a certain price for a given period of time, we might want to sell an option on that position. So let's just say, for example, that we think that oil is going to go down for the next couple of days, and our belief is that price is going to stay below $74 for the next couple of days. Okay, we believe that price is going to stay below $74 for the next 3 days. That essentially says we don't think that oil is going to go up more than 5% over the next 3 days because we're using an option that's going to expire in 3 days. So when I go to my trading view and I look at my options positions, I've already pulled up the options chain for USO. Now, if you notice here, I've pulled up the USO October 21 option, which expires in 3 days. Now, down here in the middle is my strike price. My strike price is listed down here in the middle. And then over on the left is my bid and ask of my calls, and on the right is the bid and the ask of the puts. So I've got my bid and my ask available here. Now notice the at-the-money option, which is right around 70, is my highlighted option at the moment because that's my at-the-money position. Well, if I believe that the stock is going to stay below a certain price, I'm going to do an options position called a bear call spread. And when a bear call spread happens, I'm going to sell an option and then buy another. So in this case, I'm going to sell the $74 option. I'm going to buy the $75 option. Now, when I do this, I'm essentially saying I'm going to sell the $74 call option, and I'm going to bring in a credit for that of selling that $74 call option. I'm going to bring in about a 51-cent credit for selling that option. Well, Okay, 51 cents is pretty good, but now I have unlimited exposure if the stock goes up above 74. So how do I protect against that? Well, at the same time, I buy the $75 call option. Now, that $75 call option is going to it's going to cost me some money in order to do that. Now, when I do this, I'm going to get a total net credit of 16 cents. I'm getting a net credit of 16 cents. So what does that mean? Well, a net credit of 16 cents means that I'm bringing in 16 cents on my $1 of risk. So $1 of risk, but I'm not really risking the full dollar. I'm only risking the dollar minus the credit. So $1 of risk minus 16 cents. So that would be 84 cents of risk. So what's my rate of return on that? Well, 16 cents divided by 84 cents would be a 19% rate of return. Now, that means that I can make a 19% rate of return on this options position in 3 days. It's a 3-day return, and price can go up, down, or sideways for 20%, for essentially a 19% rate of return. Well, that's wonderful. But what about commissions? See, in most brokers, you're going to have to pay some sort of an options commission. Now, some brokers, the standard might be 65 cents a contract. If the standard is 65 cents a contract, I would be paying $1.30 in commissions for this trade that's only going to bring me a 16-cent credit. Well, that wouldn't make any sense, would it? I'd be losing money on the trade just in commissions alone. Okay? So what do people do? Well, oftentimes what people will do is they'll say, well, instead of doing the 74 by 75, let me do the 74 by 78, right? Oh, look, now I have a 39-cent credit. But I've taken my risk and I've tripled it. I now have triple the exposure because I went from a $1 spread to a $3 spread. So while I got a bigger credit, I now have a $3 spread, right? $3 spread minus my 39 cents is going to be 261. So 0.39 divided by 261 is a 15% rate of return. 14.9% rate of return. So my rate of return has been dropped by 5%, and I've increased my overall risk. Now, and I still am going to pay, let's say I'm paying 65 cents a contract, I'm still going to pay the same $1.20 and $1.30 in commissions, and so the trade still isn't going to be worth it to do. So then people say, well, I just going to have to go further out and take more time, and more time equals more risk. So if I've got a broker that's not charging me commissions, I can still do, because by the way, I'm still going to be wrong at that $74 amount. I'd rather be wrong at that $74 amount with only $1 worth of exposure in that position, okay? And so that is what we're looking at when we look at the impact of commissions on options, is the ability to do narrow spreads that have short-term expiration. In this case, a 3-day expiration. So I know that's a little bit more of a complicated topic and a little bit more of a complicated issue, but I wanted to at least bring that up and share that with everybody, because we're going to have an expert on Thursday, October the 20th at 7 p.m. Central. We're going to have an expert come up, and he is going to talk about how does options trading work with the minimization of commissions. He's a professional options trader that was a trader on the CBOE, Lex Lutheringhausen from TradeSarmy brokerage firm. He's actually the developer of TradeHawk, the platform that I was using today, and he's going to talk about how can I utilize how can I minimize the impact commissions have on my options trading. It's totally free. We want to have you come and join us. It's going to be super cool. He's got a lot of insight to share. So go to TradersArmy.com/Tradier to register. It's going to be a free workshop. And I look forward to having you there and having you join us on Thursday the 20th at 7 p.m. Central. TradersArmy.com/Tradier. Can't wait to see you there. Hope you guys have a great day. See ya.